Imagine this. You put your money in a savings account. You feel a sense of security knowing that your money is safe and earning interest. It earns a little interest, maybe a few percent a year. It's better than nothing, but it's not exactly making your money grow significantly. But what if you could make your money work harder? What if there was a way to potentially earn more without having to constantly monitor the stock market yourself? Mutual funds offer a way to potentially earn more. They are managed by professional fund managers who make investment decisions on your behalf. They let you invest in a diversified portfolio of stocks, bonds, or other assets. This diversification helps spread risk and can lead to more stable returns over time. This can lead to higher returns than traditional savings options. By pooling your money with other investors, you gain access to a wider range of investments than you might be able to afford on your own. Think of Sarah, a young professional. She was looking for ways to grow her savings and secure her financial future. She started investing in mutual funds early in her career. With the guidance of a financial advisor, she chose funds that matched her risk tolerance and financial goals. Over time, her investments grew. She regularly reviewed her portfolio and made adjustments as needed, but she didn't have to worry about the day-to-day management of her investments. The power of compound interest worked its magic. By reinvesting her earnings, Sarah's money grew exponentially over the years. Now, she's well on her way to achieving her financial goals. She feels confident about her financial future and is excited about the possibilities. Mutual funds are like vehicles that can drive your money towards growth. They offer a convenient way to invest in a diversified portfolio without needing to be an expert in finance. They offer accessibility, diversification, and the potential for higher returns. Whether you're a seasoned investor or just starting out, mutual funds can be a valuable part of your investment strategy. Whether you're saving for retirement, a down payment on a home, or your child's education, mutual funds can be a powerful tool in your financial journey. They provide a way to grow your money over the long term. Remember, investing involves risk. The value of your investments can go up and down, and there's no guarantee of returns. But with careful planning and a long-term perspective, mutual funds can help you build wealth and achieve your financial dreams. So, if you're ready to make your money work harder, let's dive into the world of mutual funds. Explore the options, understand the risks, and start your journey towards financial growth today. What exactly is a mutual fund? This is a question many new investors ask when they first start exploring the world of finance. Understanding mutual funds is crucial because they are one of the most popular investment vehicles available today. Think of it like a basket. Just as a basket can hold a variety of items, a mutual fund can hold a variety of investments. This basket holds a variety of stocks, bonds, or other assets. These assets are chosen by professional fund managers who aim to achieve specific investment goals. When you invest in a mutual fund, you're buying a share of this basket. This means you own a small part of all the investments within the fund. Imagine you and your friends want to buy a variety of fruits. Each of you has a different preference, but you all want to enjoy a mix of fruits. You each contribute a small amount of money. By pooling your resources, you can afford to buy a larger variety of fruits than you could individually. With the pooled money, you buy a basket filled with apples, oranges, bananas, and grapes. This way, everyone gets to enjoy a bit of everything. Each of you owns a share of the entire fruit basket. This means you all benefit from the variety and quantity of fruits purchased. This is similar to a mutual fund. Instead of fruits, the mutual fund holds a variety of financial assets. Instead of fruits, a mutual fund holds stocks, bonds, or other assets. These assets are selected to meet the fund's investment objectives, such as growth, income, or a balance of both. Instead of you and your friends, it's a group of investors pooling their money. This collective investment allows for greater diversification and access to a wider range of assets. You buy shares of the mutual fund, giving you a piece of ownership in the underlying investments. This means you share in the gains and losses of the fund's portfolio. Mutual funds offer a simple and convenient way to diversify your investments. Diversification is a key strategy in investing because it helps spread risk across different assets. You get exposure to a range of assets without having to buy each one individually. This can save you time and effort, and it can also reduce the risk associated with investing in a single asset. This diversification can help reduce risk and potentially increase your returns over time. By spreading your investments across different assets, you are less likely to be affected by the poor performance of a single investment. This balanced approach can lead to more stable and consistent returns, making mutual funds an attractive option for many investors. Additionally, mutual funds are managed by professional fund managers who have the expertise and experience to make informed investment decisions. They continuously monitor the market and adjust the fund's portfolio to align with its investment objectives. This professional management can provide peace of mind to investors who may not have the time or knowledge to manage their investments actively. Before investing in a mutual fund, it's important to read the fund's prospectus. This document provides detailed information about the fund's investment objectives, strategies, risks, and fees. Understanding these details can help you make an informed decision and choose a fund that aligns with your financial goals. In summary, mutual funds offer a way to invest in a diversified portfolio of assets with the convenience of professional management. They can be a valuable addition to your investment strategy, helping you achieve your financial goals while managing risk effectively. By understanding the basics of mutual funds, you can make more informed investment decisions and take steps towards building a secure financial future. So, whether you're a new investor or looking to diversify your existing portfolio, mutual funds can be a great option to consider. Just like fruits come in different varieties, each offering unique flavors and benefits, mutual funds come in different types, each designed to meet specific investment needs and goals. The most common types are equity funds, bond funds, and balanced funds. These categories help investors choose the right mix based on their financial objectives. Each type has its own risk and return characteristics, which are crucial to understand before making an investment decision. Equity funds invest primarily in stocks, which are shares of ownership in companies. Stocks represent ownership in companies, giving investors a stake in the company's performance and potential growth. They offer the potential for higher returns, but also come with higher risk due to market volatility and economic factors. Bond funds invest in bonds, which are essentially loans to governments or corporations. These entities promise to pay back the loan with interest over a specified period. Bonds generally offer lower returns than stocks, but are considered less risky. They provide a steady income stream and are less susceptible to market fluctuations. Balanced funds, as the name suggests, offer a balance of stocks and bonds. This mix aims to provide both growth and income. They aim to provide a moderate level of risk and return, making them suitable for investors seeking a middle ground between high risk and low risk. The specific allocation between stocks and bonds varies depending on the fund's investment objective. Some balanced funds may lean more towards stocks for growth, while others may favor bonds for stability. Choosing the right type of mutual fund depends on your individual financial goals, risk tolerance, and time horizon. It's important to assess how much risk you're willing to take and how long you plan to invest. For example, if you're young and saving for retirement, you might consider a higher allocation to equity funds. This is because you have a longer time horizon to ride out market fluctuations and benefit from potential growth. If you're closer to retirement, you might prefer a more conservative approach with a higher allocation to bond funds. This strategy helps preserve capital and provides a steady income stream as you approach your retirement years. Diversification is another key aspect to consider. By spreading your investments across different types of funds, you can reduce risk and improve the potential for returns. A well-diversified portfolio might include a mix of equity, bond, and balanced funds, tailored to your specific financial situation and goals. Long-term investment strategies often benefit from a diversified approach, helping you navigate different market conditions and achieve your financial objectives. Regularly reviewing and adjusting your portfolio is also important. As your financial situation and goals change, your investment strategy should evolve to stay aligned with your objectives. Working with a financial advisor can help you make informed decisions and create a personalized investment plan that suits your needs. Ultimately, the right mix of equity, bond, and balanced funds can help you achieve financial security and peace of mind, allowing you to focus on what truly matters in life. Mutual funds offer three main ways to grow your wealth: dividends, capital gains, and appreciation. Understanding these mechanisms can help you make informed investment decisions. Dividends are payments made by companies to their shareholders. When a mutual fund holds stocks that pay dividends, those dividends are distributed to the fund's investors. Capital gains occur when you sell an asset for more than you paid for it. If a mutual fund sells a stock or bond for a profit, those gains are distributed to investors. Appreciation refers to the increase in value of an asset over time. As the underlying investments in a mutual fund grow in value, the value of your mutual fund shares also increases. It's important to note that past performance is not indicative of future results. The returns generated by a mutual fund can fluctuate depending on market conditions and the performance of its underlying investments. However, by understanding the different ways mutual funds generate returns, you can make more informed decisions about which funds align with your financial goals.